This CKNW podcast is brought to you by Destination Toyota in Burnaby, your neighborhood Toyota store.
Hey, by the way, just let me answer a couple of email questions getting asked why we don't go to Calgary. Well, I'm going to be in Calgary on October 27th for an all-day seminar, lots of free stuff there. It's going to be great, and so I'll give you more details on that, but that's Sunday, October 27th. So I know it's about 7 weeks away, so you might want to still mark it down. I'll see you there, Calgary, October 27th. Right now, Greg Weldon joins me, Weldon Online. I always look forward to having Greg on the show with me. His breadth of knowledge takes a backseat to no one. Greg, I appreciate you finding time for us on the weekend.
It's always my pleasure, Michael. How you doing?
Good, and especially now that the NFL season is starting, I will be making my traditional loser bet on the Giants coming up. So,
not always a loser bet. We got a few trophies.
Yeah, you're absolutely right, and I'm still celebrating them. Greg, I want to talk a little bit. I mean, you do, as I say, Greg's stuff is terrific. It covers with a depth that literally I think is unparalleled in the industry, but he covers whether it's fixed income and bonds, stocks, but it could be around the globe, whatever is interacting with the various markets looking for opportunities. But today I want to start with U.S. interest rates, come to Canada's interest rates we were just talking about. Let's start with the U.S., though. A lot of talk about cutting back on the quantitative easing, cutting back on that $85 billion a month purchasing. It's called tapering they're talking about. Number one, do you think that's going to happen? And number two, every time they've talked about that in a serious way, the market's taken a real hit.
You know, there's really kind of three different angles you almost have to look at it. You know, it's not whether it should happen or shouldn't happen. I mean, it should happen because this level of stimulus really isn't sustainable. But the degree to which it is needed is really kind of the key question. And I think the labor numbers on Friday in the U.S. clearly show us that the labor market is still dysfunctional with really a massively big hole in terms of the number of people who are unemployed, that can't find work, that are no longer counted. 90 million in the U.S., not in the labor force. That's up by 12 million since 2008. And you have not had job growth enough to take that down, even over the last year in the U.S. Really, year to date, 1.6 million people have gone into the category of not in the labor force. And household employment is up only half of that. So you can have these job gains, and it's all well and good, but you are still losing in the end result in that less people are employed actually, and more people are dropping out. The Fed is aware of this. From my perspective, a lot of this from Bernanke has been verbal intervention. Let's float the idea of tapering. Let's see what the markets do. Let's give ourselves a little more wiggle room, and we can see with interest rates, they've gotten themselves quite a bit of wiggle room in that bond yields have gone up significantly on the thought that they would taper. Now, if they don't, you'll see bond yields come down. You'll see asset prices kind of stabilize and maybe even reflate from here. The potential here is for an error. I mean, they feel under pressure. Bernanke is leaving. He has legacy issues. There's international pressure. You hear comments out of places like Russia in the G20 where this level of stimulus is not acceptable on a long-term basis. So an error here would be if they actually did taper. I think you've gotten a preview over the last 2 to 3 to 4 months as to what the environment in the markets would look like if they taper, and it's frankly not a pretty picture.
Let me come to Canada then, Greg, in that, we got some unemployment numbers. There's not a consistency, though, in these economic numbers. I mean, one day it's okay and the next day it's not, and you can pick out some bright spots like auto retail in the States last week, or, our housing was better in August compared to August 2012, but I mean, my goodness, it was so abysmal in 2012, so what? But, I'm just wondering, now we're getting every week we seem to have a new debate about when Canada's going to raise their interest rates.
And what's really interesting is some of the data in Canada. Retail sales is a perfect example. You had a big monthly increase for July, just posted this week. And, it looks really good. It's a sizable increase. It's a year-over-year gain. But when you strip out the components, you see that it's very much around autos and fuel. Without automobiles, it's actually a much, much smaller gain and, in fact, declined on a year-over-year basis. You have so many inconsistencies and really fractures in this economic data. For example, the employment number you just got in Canada looks like a great number, huge monthly increase, But when you break it down, again, it is mostly part-time. There's not as big a full-time component. You're coming off a couple of big declines that were not expected. So there is some fracture within the data that suggests that if they were to tighten policy and interest rates were to go up even more, you could choke off this recovery before it really gets traction and to where it's spread into kind of the broader components of some of these data points.
The point I want to just reemphasize what you're saying, Greg, is that people have to appreciate that interest rates have gone up, just not the bank rate. So interest rates have gone up. Why? Because the bond market has been anticipating higher rates, or they don't want to they want more payment for risk. But whatever it is, we've seen a pretty good jump in, say, the 10-year bond rate in both Canada and the U.S.
What's really interesting is this kind of, this convergence of time and space right here with this employment number in the U.S., with now even backtracking from the Chicago Fed, the St. Louis Fed, the San Francisco Fed, the Minnesota Fed. Commentary on Friday across the board was dovish that maybe we even need to be adding more stimulus. That's a comment that actually came from one of the Fed governors. You tie that into where the 5-year U.S. Treasury note yield got to on Friday. The high was just shy of 188. Now, why is this important? It's important because the average coupon yield on $14 trillion of U.S. Treasury debt outstanding is 188, and the average maturity is 5.4 years. The bottom line for me is that's the Maginot Line. That is the line in the sand. It is drawn where you get the 5-year note yield above that. It is now costing the U.S. government more and more money to roll over this enormous debt. To me, that is kind of a tipping point to where the Fed probably can't let it get too much higher than that, or you start really kind of resurfacing this whole fiscal issue. You've gotten some relief from that anxiety because the U.S. deficit is going to be smaller this year. But the problem is, if it weren't for the last 3 years, this year's deficit would be a record deficit. So it's not to say it's still not a problem. It's still a major problem, and it would be exposed if the 5-year Treasury bond yield were to move above 190, and you're pretty much right there. So it's difficult to see how they really can taper, but then you look at the international situation, and you look at the deposit rate strip. Now, what that means is when you look at the futures contracts and what is being priced for interest rates 1 year and 2 years from now has significantly risen, and this is everywhere. It's in Europe. It's in Canada. It's in the UK especially, and it's in the US, where the market is now suggesting that central banks are going to have to raise rates sooner and by more than we thought just 3 months ago. The market is saying this. Now, it may be a situation where the Fed doesn't want to see that happen. How are they going to fight this? This thing is really set up to be a very interesting, basically a war in the bond markets in the fourth quarter of this year.
And again, this is just have such profound implications for the various investment markets, and I'm going to talk with Greg about that when we come back from the break, whether we're talking stocks. If you're interested in gold and silver, I'll come to those also, maybe a little currency action, all of that with Greg Weldon. You find him on weldononline.com, WELDON online.com, weldononline.com. Great stuff. He produces a daily service. I'll tell you more about that. All coming your way right across the Chorus Radio Network. Just talking about the key component of the investment world, at least key focus has been what the Federal Reserve is doing, printing up a ton of money. What are the implications for the market? Well, the debate now is, are they going to cut back? Greg Weldon is online with me. And speaking of on our line, but speaking of that, you can find Greg at www.weldononline.com. Greg, I was just sort of smiling during the week thinking of you coming on, and now you're producing, of course, daily. I was wondering, going back 20 years, did you ever think there's going to be so much action, you got to cover so many markets, that you got to do a daily thing on it?
Well, to me, Michael, my mantra always is everything matters, and that's never been more true than it is now. And just during the break, I was just kind of thinking, when you look at all that's going on here in terms of, interest rates and the Fed and tapering, and then the geopolitical risk and the uncertainty linked to Syria and how that might impact oil prices, and what does that mean for bonds, and holy mackerel, there really is so much happening that, this is my passion, to get up every morning and sink my teeth into it. And we have to cover all these areas. We've kind of gone back to basics, doing more of what we used to do 17 years ago when I started this company and producing research when it was daily, and it did cover everything. And we got more towards